Did you know that 90% of the world's millionaires have been created by investing in real estate? And yet, there are certain investments they steer clear from. A shocking fact, isn't it? But it's true. Not all investments are created equal, and the financially savvy understand this. They know where to put their money and where not to. That's what sets them apart. So, what are these investments that the affluent avoid? Let's dive in. First on the list is new cars. Now you might be wondering, why would the wealthy avoid investing in new cars? The answer lies in the concept of depreciation. You see, the moment a brand new car is driven off the dealership lot, its value begins to drop dramatically. In fact, most new cars will lose about 20% of their value in the first year alone. And by the end of the fifth year, some cars can depreciate by as much as 60%. This rapid loss of value makes new cars a poor investment choice for those looking to grow their wealth. Instead, the rich often opt for quality pre-owned vehicles, or they lease, effectively sidestepping the financial pitfall of depreciation. So, the next time you think about buying a new car, think again. You might just be driving your hard-earned money away. Secondly, the rich never invest in penny stocks. Now you might ask, why is that? The answer lies in the inherent risks associated with these types of investments. You see, penny stocks are low-priced, small-cap stocks, typically valued at less than $5 a share. They are often associated with small, obscure companies and are notorious for their lack of liquidity, poor financial reporting, and high volatility. The wealthy understand that the allure of quick, substantial returns is often overshadowed by the potential for massive losses. They know that penny stocks can be easily manipulated due to their low trading volume, making them a playground for fraudulent schemes. Moreover, the lack of reliable, accessible information about the companies behind these stocks introduces a level of uncertainty that the rich prefer to steer clear of. In essence, the wealthy choose to invest their money in more reliable, proven assets, avoiding the risky gamble of penny stocks. Remember, not all that glitters is gold. Thirdly, they avoid investing in high-end electronics. Now, you might be thinking, but aren't those flashy gadgets a symbol of wealth? Well, not quite. You see, the wealthy understand something crucial about electronics. They depreciate, and they do so quickly. That latest smartphone or high-tech gadget might seem like a good investment today, but give it a few months and it's worth significantly less, but there's more. The world of technology is constantly evolving, with new models and versions hitting the market faster than you can say upgrade. The rich know this. They understand that the value of these items is fleeting, here today and gone tomorrow. So if you're looking to build wealth, take a leaf out of their book. Don't pour your hard-earned money into electronics that will only depreciate and become obsolete. It's better to invest in timeless assets. Fourthly, the rich steer clear of investing in timeshares. Now you may be thinking, who wouldn't want a piece of paradise? A vacation home sounds like a dream, right? Well, not quite. Timeshares are notorious for their limitations and hidden costs. Firstly, while your timeshare may seem like a ticket to annual vacations, the reality is that your usage is restricted to specific dates. Flexibility? Not so much. Then, there's the matter of maintenance fees. These pesky costs tend to increase year after year, and here's the kicker: you have to pay them, whether you use your timeshare or not. Lastly, timeshares are notoriously hard to sell. The market is oversaturated, which means when it's time to sell, you may find yourself stuck with a depreciating asset. So the next time you're tempted by the allure of vacation homes, take a step back. Don't let the allure of vacation homes cloud your judgment. We're halfway through our list. If you're finding this video helpful, please hit the like button and subscribe to our channel for more insightful content. Let's keep going, shall we? Fifth on our list is investing in unproven technology. Now you might be thinking, but wait, haven't many become wealthy by investing early in groundbreaking technology? And yes, you're not wrong, but the key word here is groundbreaking. Many technologies promise to be the next big thing, but only a handful truly revolutionize the way we live and work. It's a risky game, a bit like finding a needle in a haystack. This is why it's so crucial to do your research before investing. Look into the company's track record, their financial health, and the viability of their product. Listen to experts in the field and keep an eye on market trends. It's not just about the potential rewards, it's about understanding the risks. So remember, when it comes to investing in unproven technology, it's not about being the first, but about being the smartest. Sixth, the rich never invest in luxury clothing. It's a common misconception that the wealthy spend a fortune on designer labels, but in reality, they understand something crucial. Luxury clothing depreciates in value the moment you walk out of the store. It's like buying a new car and driving it off the lot. The value plummets. The rich know that fashion is ephemeral, changing with the seasons, and that today's hot trend might be tomorrow's fashion faux pas. Hence, they prefer to invest in timeless style rather than transient fashion. They opt for quality over brand names, choosing classic pieces that withstand the test of time. Just like how they approach their investments, the wealthy are strategic about their wardrobe. They understand that true value isn't in a price tag, but in the longevity and versatility of a piece. So the next time you're tempted by that high-end fashion item, remember this key principle. Remember, style is eternal, but fashion is fleeting. 7th, they avoid investing in commodities. The rich understand the inherent volatility in the commodities market. It's like riding a roller coaster without a safety harness. Thrilling, yes, but also incredibly risky. You see, commodity prices can fluctuate wildly due to a multitude of factors. These can range from geopolitical tensions to changes in supply and demand, even down to the whims of the weather. And unlike stocks, where you can analyze a company's financial health, commodities are largely dependent on external forces beyond any investor's control. Furthermore, the commodities market is often a zero-sum game. For every winner, there's a loser. It's a high-stakes game, where the losses can be as monumental as the gains. The wealthy prefer to invest in assets that generate consistent returns over time, rather than gambling on the unpredictable swings of the commodities market. Investing in commodities is not for the faint-hearted. 8th on our list is investing in collectibles. Now, don't get me wrong, collectibles can be fun. There's a certain thrill in hunting down that rare comic book or vintage stamp. But when it comes to serious investing, collectibles carry a hefty risk. Why, you ask? Well, their value is highly speculative. Unlike stocks or real estate that generate income over time, collectibles don't produce anything. Their worth is entirely based on what someone else is willing to pay for them. And that, my friends, can fluctuate wildly. Today's hot ticket item could be tomorrow's dusty shelf filler. Moreover, there's the issue of authenticity and condition. A tiny scratch or a missing certificate of authenticity can plummet the value of your collectible. So, while it's perfectly fine to indulge in collecting as a hobby, when it comes to long-term wealth creation, it might not be the wisest route. Investing in collectibles is more of a hobby than a serious investment strategy. The last 3 points are investing in risky business ventures, low-return assets, and non-income producing assets. Let's delve a little deeper into each of these. Risky business ventures. These are the kind of investments that either take off and bring in a fortune or crash and burn, taking your capital with it. The rich understand that it's better to invest in steady, reliable ventures that may grow slower but offer far less risk. Next, we have low-return assets. These are the investments that, yes, may be safe, but their return on investment is so low that they're not worth the time or money. Wealthy people know that their money can be put to better use elsewhere, in assets that offer a higher return. Lastly, non-income producing assets. These are things like luxury cars or extravagant vacations. While they can be enjoyable, they don't produce any income or increase in value over time. The rich prefer to put their money into assets that will generate income or appreciate in value, such as real estate or stocks. So, these are the 11 things the rich never invest in. Always remember, it's not about how much money you make, it's about how much you keep. I hope you found this video helpful. Your time and attention mean a lot to me. If you've enjoyed our journey through the things the rich never invest in, show us some love. Tap that like button. It helps us more than you know. And don't forget to subscribe and hit the notification bell, so you never miss out on our future insights. Stay tuned for more insightful content. Until then, keep investing wisely. I will see you in the next video.